And we are back with another episode of the Investor Guys podcast. That eager, enthusiastic gentleman is Bill Barnett. I'm Kevin Mills. Welcome for anybody who hasn't been here before. Welcome back for all of you who keep rejoining us, and thank you for all of you who keep rejoining us. Today we have a topic, and I'm going to let Bill tell you about that while I set our timer here.
Kev, dog, good seeing you as always. Brother, you know, one of the things that Kevin and I talk about a lot off podcast is state of the market, where the market's going, what are we going to do when it gets there, the changes that we see happening. And so we're like, you know, why don't we just do a show on that? Because as an investor, and I've talked to some people that were looking into getting started investing, and they were scared to death. Oh, don't know what's going to happen with the election. Oh, don't know this. Oh, don't know that. And so they're frozen. They're not doing anything. Well, what I want to do is dispel a few rumors today and a few myths about the market, and let you know that, first of all, immaterial as to who wins the election. Once we get into 2021, the market in real estate is going to turn down. It's not going to turn down because of the election. It could turn down faster if Biden wins.
Here's the thing, it's not going to turn down because of the election, but historically, we always see the market drop after an election, historically. Whether we have an incumbent or whether we have, you know, a new candidate who's coming into office, historically, after an election, we see the market drop. And that's because presidents who are in office try to keep the market strong, because one of the biggest factors, as all of you know, especially this year, one of the biggest factors is economy. And if our real estate market is strong, our economy is strong. So the president that's in office will try to keep that as strong as possible, always through the election. And then traditionally, we'll see that taper off after an election. But it has nothing to do with the candidate who's being elected. Every president wants us to have a strong economy. Whether they're good at making that work or not is a different situation. But real estate as an investment is not going to change. And I'm sorry, Bill, I didn't mean to interrupt you.
Hello, and welcome to the Investor Guys podcast, the ultimate podcast for serious real estate investors in the know. Join your host, Bill Barnett and Kevin Mills, as they share their expert insights, strategies, and tips to help you succeed in the world of real estate investing. Get ready to level up your investment game with the Investor Guys podcast. And now, here are your hosts, Bill Barnett and Kevin Mills.
And that's great points. One of the things I always look at is the fact that the market operates independently. And so you look at the market turned, depending on who you read. For me, I followed December 2012 because I own a brokerage firm, and I was able to see that in December of 2012, we had a month that looked like a summer month. We just had this incredible month. Now, remember, we had gone through about 8-9 years of just with the foreclosure debacle created by Obama. And so then we had the market just turned like that. Now, it didn't turn like that. It appeared to turn like that. We had about 14 months prior to that, and doing a weekly radio show, I kept telling our listeners, hey, understand that we're getting better and better and better. Here's these underlying factors that are turning the market. And right now we see the same thing. Now, what we see today is we've already had about 16 months of the market turning, but it's turning the other direction. And so these are not things that the real estate uneducated public sees. This is not anything that the business environment, the guys, I crack up a lot of times when I'm watching business TV with Bloomberg and those kind of stations. And I just go, where do they get these knuckleheads? They learn a little jargon, and many times it's what they're talking about is just trash. But the real estate market has a lot of underlying factors. All of those factors are turning negative, and they're turning so that we'll probably see third quarter next year. There'll be a high after the election or a low after the election, either one. But first quarter is typically slow in real estate anyway, because January, people are starting to wake back up. We're past the holidays and kind of getting their mind back on business. February, we pick up a little steam. Then we start getting into March and April. Now we're starting to see the real estate market move again. So we get into April, we start into the official buying season, and we run that through September. When we get into September of 2021, now the summer buying season next year may not be quite as hot as it has been, but I don't think it's going to be a point where people are going, oh no, the market's turned. But once we get into September and the market has a traditional slowdown anyway, fourth quarter, we're going to see it go. And when we get into 2022, it's not going to change. It's going to continue to get soft.
When Bill says negative, he doesn't mean negative across the board as far as being involved in real estate. What he means is for sellers, for example, the benefits are going to turn towards a negative. So we're going to see prices on houses and real estate as a whole drop. We're going to see that coming down. That's not a negative for us as investors. That's a positive. We're going to see more foreclosures, unfortunately, because even we've got the coronavirus that we have to deal with. The coronavirus is going to cause a lot of foreclosures. Coronavirus notwithstanding, we always go through cycles. We have cycles where we're going to see more foreclosures and less foreclosures, and more foreclosures and less foreclosures. If you're a real estate investor and you're doing this for another 10 years, no coronavirus or anything else, you're still going to see this cycle through every 3 to 7 years where we have this boom and then we have a recession. We have a boom and we have a recession. And it always happens in real estate. And it usually correlates with the economy, but it doesn't always correlate with the economy. Sometimes you can have a booming real estate market in a slow economy. Sometimes you can have a booming economy and a slower real estate market. Usually when the economy is booming, your real estate market is solid, but it may not be booming. Just because we have a booming real estate market doesn't mean that the economy is doing great. So when he says negative, he means as far as if you are a seller and you're trying to sell property right now, your potential is going to be less. Your potential as an investor purchasing these properties is going to be greater. And another thing that happens when we see this, just like we see if we're watching the market, okay, and Bill knows this, when stocks are up, bonds are usually down. And when bonds are up, stocks are usually down. When we go through this type of a situation where we have more foreclosures and we have a slower real estate market as far as longer days on market, we see rentals going up. We see the demand for rental property going up. We see the cost of rentals going up. So there's always a silver lining on both sides. And I'm going to let this go real quick with a quote from I can't remember his name, but he says that as a real estate investor, the light is always green for us. And it really is. So if it's a buyer's market, then we buy. If it's a seller's market, we sell. As a real estate market, we're not focused on, or an investor, we're not focused on one thing. We've got two sides to all of this. I'm going to take a break real quick and we'll be back in a second.
Thank you for watching the Investor Guys podcast.
The Investor Guys podcast will be back shortly.
Absolution X, limited editions, lifestyle apparel like none other. Get yours today at absolutionx.com.
Live the resort lifestyle every day with Cayman K. The perfect pieces for every wardrobe. Shop the entire Cayman K collection and find your favorites. Find all our styles at caymank.com.
And we are back, and we're brainstorming through the commercial, trying to figure out the name of that particular educator, and I can't for the life of me. As soon as we're done with the show, I'll remember it. And I'll post it on Facebook for the rest of you. The light is always green for us as real estate investors. We always have strategies that we can use no matter what. And that's why it's important, really, and we're going to do a show on education next week, but that's why it's important to have multiple tricks in your bag. If you're a one-trick pony and you're focused on just one strategy, then the market changes. you're basically sitting with that bag waiting to get out as soon as the market changes back to something that's prime for you for what you know. Having multiple different strategies that you are able to work makes it beneficial for you, and it makes you a real actual investor. Going into the market that we are looking at, and it's going to get slow. And again, it's not just coronavirus. This happens no matter what. This is something you need to understand as a real estate investor, no matter what. Even if we didn't have coronavirus in 2006, 2007, 2008, our market made drastic changes in those years. If you were ready, if you were prepared, if you were purchasing properties using strategies by the number, then you were doing well. A lot of real estate investors, and I heard this and I saw this, a lot of real estate investors lost their shirts in 2006, 7, and 8. I have students just like Bill does, and the thing that I teach them all the time, run the numbers, run the numbers, run the numbers. Make sure you have an exit strategy that is solid that you run the numbers on. And I'm happy to say that I got tons of phone calls from my students. I still get phone calls. And if you look at my Instagram, you can see they follow me too, saying that all the time. I'm so glad that I ran the numbers. I'm so glad that I used a strategy that wasn't reliant upon the market, because the market at that point was not something we could rely upon. And that is understanding where the market's going, but being able to take advantage of situations like this, because whenever you have movement, and that's where Bill was going with this, I don't mean to take the air out of his balloon, but whenever we have movement, we have opportunity. Yep. So whether the market is going up or going down, we have an opportunity all the time, but whether the market is up or down, we have more opportunities. That just, it opens up for us. And it's almost like going to a buffet, but real estate opportunities are what's on the menu. And you can just literally sit and pick and choose, and there's no way you're going to be able to eat it all.
It'll be interesting to see from a kind of a 50,000 foot level. If Trump wins the election and we enter into a possibility, don't know it'll happen this way, but the possibility that the stock market stays strong while the real estate market goes down. That's a very distinct possibility should he win. If Biden wins, they're both going to go down. They're going to go down faster. The weird thing, and I was earlier in the segment 1, I'd said it really doesn't matter which one wins. This is what's going to happen, which I stand behind. There is the wild card out there, and the wild card is this. Bush started this debacle, and Obama followed through with it as if it made good sense, which was this stimulus package that they put together. It's Bush came up with this idea, and I was just sitting there going, I was pretty much in his camp until then. I'm totally out of the Bush camp now. I think he's an embarrassment, but that's another story. So they put together this, we're going to drop a whole bunch of money into the economy and the stimulus package. And he started it right at the very end. He'd already lost the election, or not lost, he'd finished his second term, excuse me. So he started it then, and then Obama took it up and pushed it on forward and moved. Well, what it did was it stopped the market. Now, it didn't stop the real estate market from buying and selling. It stopped movement. When they fed several $1 trillion, about $12 trillion into banks and mortgage companies, mainly the 5 major banks. I always crack up when I hear Democrats talking about Republicans are all about big corporations and big money. No, look at history. Go back and look at that, and you'll see the greatest friend that big business has is the Democratic Party. They fed all of that money into these companies, and they were able, the banks and mortgage companies were able to stop lending money. And that's what caused so much great distress in the real estate market, because it doesn't matter if rates are up or down. People are still going to buy a house. What matters is the availability of money and being able to move forward. Well, when these banks and mortgage companies got a free ride for about 18 months, where they didn't have to perform their job because the government had handed them this massive check, and they were just sitting there going, this is great. Our profit margin is up and we don't even have to do anything. We don't even have to work. And so the market got really squirrely, and the foreclosure debacle, as it's referred to, was really no more than just a business cycle. It got exacerbated by the government. It always, in my opinion, the market can take care of itself significantly better than the government getting involved. Every time they get involved, they screw things up. And the 2000 and real estate market from about 2002 to 2012, or 2004 to 2012, really highlights how they can screw things up. So we could have a soft downturn in the real estate market where it's really soft, we're going down, that's gonna happen. And at the same time, we could have a strong real estate, or excuse me, a strong stock market going on if Trump wins. That'll be really interesting to see if it happens that way. But the real estate market is turning south either way. And if you understand the opportunities and how to react to them, you're not going to be concerned about that at all. We'll talk more about that. We're
got a break coming up
as soon as we get back.
We'll see you on the other side.
Thank you for watching the Investor Guys podcast.
Absolution X. Limited editions. Lifestyle apparel like none other. Get yours today at absolutionx.com.
Live the resort lifestyle every day with Cayman K. The perfect pieces for every wardrobe. Shop the entire Cayman K collection and find your favorites. Find all our styles at caymank.com.
And we're back. Just before the break, Bill's talking about the bailout. And you know what? He was saying 5 banks, and I'm going to give you their names right now. It was Goldman Sachs, it was Chase Manhattan, it was Wells Fargo, Bank of America, and I don't remember who the 5th one was, but it was a big name just like those other names. And
it was
not
Chase.
only, what's that?
Did you say Chase?
Yeah, Chase Manhattan. Chase Manhattan, Goldman Sachs, Wells Fargo, Bank of America. Bank of America had also bought out one of the big mortgage companies that was making a mess out of everything at the same time. So they actually added to their problems. I had noticed not only what Bill was talking about with stopping the movement, but at the time, I had a company that was doing loans. I had a company that was doing modifications. I had a company that was buying tapes, and tapes is basically a slang term for buying basically groups of REO properties from the bank. And as soon as they got that government bailout money, they stopped selling us those bulk REOs. They stopped doing modifications. They stopped negotiating anything, interest rates, anything, literally, because they felt like they had gotten the golden egg from the goose and they were just going to sit on it and not do anything. They did not move with anything until they realized they were not going to get another handout from the government, and they had to make do with the money that they had. Then they started slowly, trickling things back to normal. But it put all of us on pause for a while, which really sucked, excuse my French, because we were hot, we were moving. I felt like I was a snowball getting giant because there was so much going on because of the movement in the market. And the government just put a big giant pause button on that by bailing everybody out. It's hopefully we don't see that again. The bailouts that they're talking about right now are not ones that are going to affect the real estate market in that sense. They're talking about bailing out the airlines. They're talking about bailing out the cruise lines. They're talking about doing something for mortgages, but that's not necessarily a bailout. That's probably going to be a stopgap measure to keep as many people from losing their houses. I know that states are doing something right here in Florida. In fact, on a county by county basis, they have programs where they are giving money to renters to help pay their rent or pay a portion of their rent. In Palm Beach County, where I am right now, they have another $6,000 available for the next 3 months to help pay your rent. That's pretty significant.
Yeah, a lot of
Whether
money.
that goes for 3 months or 5 months is yet to be seen. Okay, it could be 6 months, or sorry, 6,000 for 5 months, but $2,000 a month for most renters in Palm Beach County is more than what their rent would be. So it's a county by county type of situation here. Different states are doing different things. Those types of things aren't going to affect our ability, though, to find great deals, because there's going to be more great deals on the market. And that really is the gist of what our topic is today. And we've done a show on being prepared, and this is really about being prepared. We are giving you guys, look into the crystal ball for what's coming up. And it's not that Bill or I are clairvoyant. We've just seen this cycle happen a number of times in our investing career and in our lifetime. And we can see the writing on the wall, as many other people can as well. The writing is on the wall. We already know where things are going to go. We could turn it into a graph and be able to predict where it's going to go, because we've seen it enough. So
in classes, I have a infographic that I created a couple of years ago that just walks through the cycle of the real estate market, and we assign dates to it. Okay, we all agree that this is when the market started turning up, either late 2012, early 2013. And then goes through the cycle as to here's when it is likely to turn down. So here's the things that we're going to see that let us know, hey, this thing is turning. And we're seeing all of those signs right now. So one of them that we talk about regularly is there are more new foreclosures being created than there are existing foreclosures being sold. Now, your market, my market's this way, may have a fairly limited supply of foreclosures currently on the market. That's because the market is still really hot. As the market starts to cool pricing wise, you're going to see that inventory just jump. And because it takes the public a good 6 months to 9 months to figure out, oh, gee, things are a lot softer now. I can't sell my house for X number of dollars. For sellers that come into the game late. And there's always a big push at the top of the market for the people that come in that, they're always going to be late. They want to come in at the very, 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 very top. And typically what happens is they miss the market altogether. So we're going to see that a lot. We're going to see a lot of people reshifting. Just keep one of these little factoids in the back of your noggin. The real estate market changes hands approximately every 5 years. The average American owns their home in 5-year increments. So when you think about how gigantic, and it is gigantic, it is, 100+ million properties, individual properties around the country. And roughly every 5 years, that whole inventory has turned over and somebody else owns it. Some people are downsizing, some people are upsizing, some people are moving because of their job and staying in the same size. Some people are moving into an apartment because they lost their house, they got divorced, they got sick, whatever it happens to be. But that whole giant market that is our real estate single family house market turns over approximately every 5 years.
Yeah. And one more factor before we wrap up this show that really bears mentioning, especially right now, because this is a historical factor that we're looking at. More people are moving out of states like California, Illinois, New York, and New Jersey, and they're moving to places like Florida, Texas,
No, just
Nevada,
go to Florida,
Arizona, Idaho. You don't want them there, I know, but those are factors that come into play here, because we're going to see, even as this market cools off, we're going to see more people exiting those states and coming to states like Texas and Florida and Nevada and other states. Okay, we're going to see them moving into those states. So the markets for those states are not going to be as affected as, say, California's market. New York's market is already being affected. New Jersey's market is already being affected. California, if they hadn't had so many properties destroyed in fire, their market would probably be moving already as well. So we're going to see some interesting things as we get into the next few years, as people start making a migratory move to different places to get out of states that they view as not as friendly to them financially, because of taxes, because of whatever reason. That kind of plays into another factor. And we talked about this, when those things happen, rents go up. So one of the things that Bill and I do together is we have a real estate buyers event. And the cities that we look at are cities that are strong for different reasons. Cities that are strong because the market is still strong when others aren't. So we see appreciation, we see cash flow, we see opportunity stronger in these particular cities than, say, the average cities in America. There's not that many that we focus on, maybe 4 or 5. Okay, but that's something to keep in mind moving forward. Keep an eye on our website and see where we're doing buyers events. You've got 2 choices. When you see that, you can go to that city, you can spend a month there and try to learn everything and figure it out for yourself, or attend one of our buyers events, and we'll try to cram it all into your head in about 4 days and give you the opportunity to actually get out and buy properties at the same time. And you'll have a team on the ground already. You'll have someone to help you with property management. You'll have someone to help you with everything else. But getting into a new market, like I said, take our lead. We've been here before, okay? Bill and I are also not glued to our butts in one place, okay? And I'm not saying if you are that's a bad thing. But what I'm saying is we have the ability to go to different places and to invest in other markets and see what's happening in other markets. So we're able to give you the benefit of that experience. And one of the ways we do that is through this show, but also through our real estate buyers events. So keep an eye on our website, see where we are. Feel free to join us for any of our real estate buyers events that are coming up. We've got one more coming up in 2020, but we're going to be doing more in 2021. What's that?
2020 is that we're seeing the end of the year. It's already like, oh my gosh.
Yeah.
We can see it from here. Wow.
Yeah, we are. This is the last day of September. The show will actually show next week, but this is the last day. We're in October already, essentially. So we are, the Christmas decorations are up at the store. So that should be an indicator to get ready for 2021. Thank you for joining us on this fun and interesting episode of the Investor Guys podcast. Bill, I'll talk to you later on.
All right, brother.
The rest of you, happy investing, and we will see you soon.
See you, everybody.
Thank you for tuning in to the Investor Guys podcast. We hope you enjoyed today's episode. Don't forget to subscribe and stay updated on the latest trends and insights in the world of real estate investing. Also, don't forget to check us out and see all of our episodes at theinvestorguyspodcast.com. Email us, contact@investorguyspodcast.com. Remember, the key to financial success lies in staying informed and taking action. Stay tuned for our next episode, and until then, happy investing.